All right, our top story this hour, Monetary Policy Committee of the Central Bank of Nigeria has raised the monetary policy rate by 400 basis points to 22.75%. This is, of course, disclosed by Olayemi Cardoso, the governor of the CBN, during his press conference. It also increased the cash reserve ratio to 45%, liquidity ratio maintained at 30%. The asymmetric corridor also expanded to plus 100, minus 700.
The committee decided to further tighten monetary policy as follows. 1. Raise the MPR by 400 basis points to 22.75 from 18.75%. Adjust the asymmetric corridor around the MPR to plus 100 to minus 700 from plus 100 to minus 300 basis points. Raise the cash reserve ratio from 32.5% to 45%. Retain the liquidity ratio at 30%.
All right, let's discuss. We have with us Muyiwa Oni. He, of course, is the head equity research West Africa Standard Bank Group Securities. Also happy to be joined by Ajibola Tobi-Osho, emerging markets fixed income expert. Thank you both for joining us. Very glad to have you. Of course, the usual question that first starts off, did you expect this and what's your reaction, Muyiwa?
So we did expect tightening, and I think our base scenario was a 300 basis points increase. We think at the top end, a 500 basis points increase. So on the monetary policy rate front, we did think that would happen. I think in the past, we had comments around CRR increases, and it was really more a basis for unification as well on the CRR ratio front, just because you had banks materially above the minimum, while some were just around that. So I'd say in general, there was that expectation of an increase. And so I'd say broadly more in line with what market was expecting.
Thank you. Ajibola, what are your thoughts?
Yeah, same as I'm going to agree with Muyiwa. Like, we expected that the MPR rate would be hiked, but although a lot of people were perceiving maybe 300 basis points, so 400 basis points came as a bit of surprise. I mean, it showed that they're very serious at what they plan to do in terms of tightening the market and increasing the market interest rate at general. But, however, it's the asymmetric corridor that took a lot of people aback. I mean, the previous one was 100 plus 100 minus 300 basis point, now plus 100 minus 700 basis point. So that's a bit expansionary in market's opinion. I mean, you're tightening, right? You're raising interest rates, so why expand the asymmetric corridor? Why not leave it as it is? But it seems as if the CBN is hell-bent on leaving the SDF rate as 15.75, which is what banks have access to anyways if they have to place with the CBN.
Standard deposit facility,
yeah,
right?
Yeah,
okay, cool,
yeah. So
cool.
if they
Right.
have to place with the CBN. So, I mean, it just shows that the CBN is a bit cost-conscious and they are looking at the cost of it on their books also.
All right, thanks for addressing the asymmetric corridor. Muyiwa, the cash reserve ratio, that's also causing a bit of conversation from 32.5 to 45%. Some folks assume that the banks are not going to like this. What's your take on this increase?
Yeah, so it's clearly way more difficult for banks. And the reason why is because I think on average, I think as at half year, so at an audited half year, most banks were already below 40%. And so you had banks range from about 33 to 37%, particularly the larger banks. And so this clearly would signal tightening, which means more. One would see some level of, an increase in non-earning assets on the bank's balance sheet. And I suppose for some, they would typically add special bills as well. So the special bills are 0.5% that banks have had on their books for some time now. And these were CRR deposits that were converted just for qualification for liquidity ratio. And so one could move to a situation whereby at some points banks could start negotiating on that as well, depending on how tight liquidity becomes from this point of view. But I think overall it still just shows an alignment in terms of tightening. And I guess to the point of the standard deposit facility, I guess that's where one raises some concerns and questions and still goes back to the psyche or thinking of the central bank. I think there's been so much focus on cost for so long, and it's really more because at some point, I think there were concerns of the central bank having a negative capital position. And so it seems that still seems to be what's driving this whole let's not spend so much to manage liquidity or manage monetary policy, whilst if one thinks about the overlining impact on inflation, that has a far more negative impact on the economy.
Okay, I do want to get to inflation, but first, let me get to the money market fixed income side. Ajibola, Treasury bill rates, we had a primary market auction on the 21st. We still have 364-day at 19%. Thank you. Yeah, so we have it on the screen there. So what's the reaction? What's with the respect to this rate hike now? Where are rates going to go?
So initially, when the MPR was hiked, that was the first statement he talked about, the hiking of MPR by 400 basis points. We saw the spread between the bid offer in secondary market widen. Okay. So initially, before now, it was trading around 18.7, 18.6 in secondary market. The last week, and 1 year Treasury bills, but immediately he announced the 400 basis point hike. We saw that spread widened, 19.50 bid and then 18.70 offer. However, like I said, the asymmetric corridor took people aback. They got thinking. What happens is when there are a lot of changes that you see from the MPC, from MPC communique, you have to take everything as each line item and translate what the impact will be, right, eventually. So I think market is a bit, not confused, but concerned, right? Are we being hawkish or are we being dovish? As in we need to take a stand. However, we'll still expect that in all and all, it's still bearish. It's still a bearish sentiment, right? And in as much as, people will be interested in buying. A lot of people will also be interested in saving at this time. We expect that general market perspective, NPS should go up. That's your marginal propensity to save. I think 19% is a good level, and I think the market would try, DMO and CBN would try to maintain rate around 19% for the Treasury bills.
You're generally on the equity side. Do you expect any impact, I guess, if there's more appetite for fixed income and money market rates to impact your side of the pool, where you're playing?
So I guess there's that general negative relationship between equities and interest rates. And so one would expect a negative reaction from that standpoint. And from two fronts. One, with more expensive liquidity, ability for liquidity to fund equities limits, and then beyond that as well, your funding cost as a business goes higher, and so your earnings as a company reduces somewhat. So I think in the short term it's negative, but if one thinks that all these actions is to stem inflation, and so if overall operating cost over the next 12 months, for example, reduces, then that ultimately will be positive. So in the short term, you might say it's negative for equities, but this might result to a much more positive outcome in the future. Okay.
So we've done the market stuff, but for the average Nigerian, what does this mean? Is it your borrowing costs go up, or what does it mean for the...
So technically, your borrowing cost goes up. At the minimum, the lowest you can see, generally market peaks from the MPR rate. Right. MPR is technically at 23.75 now. That means 22.75 plus the 100 basis points. So that's where the borrowing cost level should peak from technically, and so the real sector may get the large of the junk, and as in terms of the negative impact, right? Because cost of production will also have to go up if I have to borrow at 23.75% at the minimum, right? So you also have some spread included in it, depending on your credit ratings as a firm. So. Yeah, it's but at the long run, like you said, if the impact is if the whole idea is that we are trying to stem inflation in the long run, by the time we then now seeing inflation taper down, of course it would go into them deciding to sit back and then maybe start cutting MPR rates.
Yeah, but I guess there's that argument as well that credit penetration is low in Nigeria.
Yeah,
and so if you think that credit rate or credit is low, so impact on credit on consumption is also low as well. And so this might not necessarily have a strong impact, because I think it's one area we had tried to look at in the past when the previous governor was really trying to stimulate economic growth through lending. And most of the analysis showed that there was very little correlation, particularly in Nigeria, with credit growth and GDP growth in general. And so whenever you hear, and so typically there's that assumption of higher rates means lower, or should I say higher rates means more expensive borrowings, which might mean less expenditure, but consumer lending or consumer loans in general, the quantum of it is very, very marginal. So retail loans account for just maybe about 9% of total credit in general. Most of the credit is still to the corporates, and they still have other options, one would argue. And so with this as well, it doesn't necessarily change consumption, because to a reasonable extent, consumption has been driven by the inflationary environment. Disposable income is much, much lower. So even if one has ability to, or rates are lower, it might not necessarily improve the ability to borrow.
Let's take a quick break. We'll have a lot of time to discuss this. We're going to continue the conversation right after this break. You're watching the Global Business Report here on Horizon News. Do stay tuned. Welcome back to the Global Business Report here on Horizon News. We're still taking reactions to the hike, the 400 basis point hike in the monetary policy rate from 18.75 to 22.75. We still have our guests, Muyiwa Oni and Ajibola Tobi-Osho. And right before the break, we were, of course, talking about the impacts on borrowing costs. Muyiwa, you were making the point that, well, I mean, generally the average Nigerian is priced out of borrowing anyway. So, Ajibola, you're going to make a point right before we went to break.
I was just going to infer that, to some extent, and then talk about the fact that, let's look at it, that even the cost of production that they're being affected by is largely from the exchange rate perspective, is the fact that the Naira keeps devaluing and keeps depreciating, and then they have to pay so much for whatever goods they need to use to produce. So we can look at it from that aspect too. But by and large, markets still infer from this rate. I mean, their start point generally will always be MPR rate. That's what they will look at, and that's what even foreign investors will look at before they then shine light into our own market. So we can then always, disregard the impact of the NPR hike in our general public. Fair enough.
All right, so I back to the both of you. The inflation discussion. They've been hiking since last year. This is another big hike, and inflation has just continued to gallop upwards. Now at practically 30%, 29.9 headline. Food inflation over 35. I'm asking you an obvious question. Is monetary policy enough to arrest inflation? So
I think we've had that debate for some time now. And I guess, so you can look at it two ways. You can look at the absolute monetary policy rate itself, or look at the transmission effect into the market and what's happened to market rates over time. And so if you look at the monetary policy rate by itself, you can argue that central bank has been increasing that rate, but you haven't seen any impact. And if you recall the first meeting the central bank, this current governor, had with the National Assembly, his point was monetary policy tools have been blunt, and it's something that needs to be corrected. And I think it's still just referring to MPR hikes without any real impact. But I would say in recent times, I would say the last 2 months, you've seen material increase in short-term rates. And that's really what one would, how one should measure tightening per se. And so with this steady increase, one might argue that we really literally just started tightening this year and haven't necessarily been tightening for a while. And so I would argue that whilst historically rates have been rising, or the central bank has been increasing monetary rates, but there's been too much unorthodoxy in the monetary policy environment that one hasn't seen that impact. But we have a governor currently trying to reverse and move back to orthodoxy, and so I would expect, to a reasonable extent, a far more positive impact. Because it's as simple as rates, for example, with higher rates, and if one sees Naira assets as more attractive for the domestic investor, you see Naira as an option and not just look at dollar assets. And even for the foreign portfolio investor as well, Naira starts looking more attractive from that point relative to other countries.
All right, Muyiwa, you deserve a drink of water. While Ajibola, you respond to the inflation matter. What's your own take?
I mean, we're both market persons, so I expect that most times we would always speak in line and in tune, right? Like you said, the short-term interest rate is already at 19%, 23.44 in
Real
terms of
yield,
yield, real yield, which is good, right? And their perspective, I mean, the foreign investors, even people, even our local market, people are become more interested in Naira asset, and that's a good sign for Naira, right?
Yeah.
So it technically means that we should see more activity in the market. We expect to see more people then start looking at Nigeria as an option to invest their money in, regardless of it also. Like you said, the whole idea of hiking interest rates, from since last year, we've been less focused on the interest rate environment in itself than just focusing on NPR. But now it seems as if the new governor is serious, is looking at how he's going to keep the regular interest rate market very high, where people can easily have access to it. Looking at the inflation print that was showed on screen, you can see that majority of this inflation is driven by food and core, right? That's the major thing that is driving interest rates. So from the back of your mind, you can know that cost is the major thing. So what we should be looking at is how to increase supply, increase the FDI activities, increase FPI activities that will bring a bit of economic growth, and then help support the activities of foreign exchange in the economy. So what we need is majorly supply, right? Increasing supply in FX market to support the economy.
Let me stick with you. I'm going to now ask about Cardoso's signaling. He already said there's going to be another meeting next month in March. What did you make of that?
Well, I would expect that we've done something now, right? We then want to see how impactful it is in the economy compared to the previous hike that has been done. But now, like we've said before, it's coupled with the fact that you also have increased short-term interest rates. So that's good. I want to sit back and then see how this would be translated. Will this encourage FPIs to come? Would they now then start seeing our market as a more interesting market to come into? Then from there, they can then now know what the next step would be, whether they should maintain or increase further, right? Because after all these things, I'm sure they will have to sit down with the stakeholders and ask them, is this around what you were expecting? Do you need more? I mean, conversations around that will then determine whether they want to increase it further or keep it at where it is. I don't necessarily mean that they will start cutting rate anytime soon. No, that's far from it. At least not until we start seeing a bit of stem in inflation. But the truth is that if I roll out new policies, if I do something to support the economy, I need to sit back and then look at the impact first of all, then I'll know the next step of action.
Data-driven. What do you make of the signaling from the governor?
Yes, I like the Ajibola as well. And I think it also just shows that the central bank is serious about the inflationary environment and the current state of the economy as well. Because my view has been, we should have had multiple MPCs right now, quite a number of emergency MPCs. And because I think it was when Sanusi was central bank governor, times of crisis, you'd have far more of those interactions because the market needs guidance. Yeah. I recall, I think it was a month ago, I was talking to an executive of one of the large beverage companies, and his own concern was everything's falling off and no word from the finance ministry, no word from the central bank, no word from the president. We all don't know what's going on. And this action really just shows that the central bank is prioritizing inflation, prioritizing the state of the economy. And so I think it's clearly positive. And I guess it just shows some level of seriousness that the current situation deserves as well.
All right. Foreign exchange, particularly the Naira, he did say, he's reiterated this over and over, that he feels it is undervalued. Muyiwa, let me stick with you. What? I don't want to put you on the spot, but is Naira undervalued? He keeps saying, and then he said that, for technical reasons, he doesn't want to go into it, but he believes it. So what?
So I guess if I start from the conversations I've had with a number of foreign portfolio investors, and I suppose even from foreign producers that have been producing locally as well, I think that there's that acknowledgement that the currency is quite cheap right now. And I think for some it's more the variation of cost. So hotel bills, just general bills now versus in the past, and it's just cheaper the country just looks cheaper relative to the past. So I guess there's that view. There's the models around looking at parity and where currency is. And for most, you still end up around 1,001 or so, and would have to be far more conservative to end up with anything close to where the currency is right now.
Yeah.
So I guess there's that consensus that, particularly from foreign investors, if you look at most forecasts as well on the currency, it's clearly looking like the currency is undervalued right now. And even for most investors looking to invest now, there's that view that one could see some appreciation in the future. But I guess there's the bigger concern of confidence. So if you look at, even with local sentiments, confidence is still extremely weak. And I suppose that's why the need for the central bank as well to intervene to allow some normalcy in the sector, in the market, is critical. Because if you think that the market has been dysfunctional for quite a while now. So I would say since 2015, really, we haven't seen a market trade. So I've been laughing at our FX traders that I think a couple of them have about 6-7 years experience. I haven't necessarily seen a market. I've been teasing that there's no difference between themselves and those malams on the streets. And it's really now that they will be tested as well to see what will happen in terms of really trading the FX market.
Ajibola, what do you think about the currency?
Like you said, mathematically, if you have to look at it mathematically, it looks as if our currency is cheap. But
to foreign investors. To
foreign investors. But one major part that I always say, and I always get to talk to about for everybody, is that you can argue whatever it is from now till eternity. Question: do I have that thing in abundance? Because the question is, it's a question of supply and demand.
Right.
If supply is there, demand will be low.
Right.
As in, demand will be, the price of the item will be cheap.
Right.
I mean, and if demand is really high, the price will be expensive. It's as simple as that. So until you start seeing a very good amount coming, I mean, support from all this other market, it's until we start seeing supply improve, until we start seeing more confidence in the central bank as an organization that is monitoring monetary policy in Nigeria. It would continue to devalue as fast as it can. But all these things are being done, signaling a lot of seriousness in the CBN, and it shows that they're ready to do what it needs to be done to taper down the aggressive devaluation in the currency. And then we should see it, get better from time to time. I would expect that all this would support inflows coming into the country. They also have all the NNPC negotiations still ongoing and all. So at the end of the day, let's see how this play out, right? Let's see how it then fits into the economy. But by and large, supply, as far as I'm concerned, you can talk about and hammer on the mathematical calculation of currency. If there is no supply, then
it's not. You're still back where you are.
Exactly.
We are out of time, but I guess maybe one more answer here. Is there more responsibility on the fiscal side? I guess maybe yes, so I can maybe have one or two words.
So I'll say yes, and just piggybacking on the whole FX liquidity situation. If we produce more oil, for example, then there's far more export proceeds from an oil perspective, and that should help and support on the liquidity side, like Ajibola alluded to. So I think clearly one needs that support, and then also fiscal discipline from the
borrowing and all that other stuff and the spending.
More fiscal discipline and spending. I mean, we need to be realistic now. Government needs to be realistic. We don't have that money, and you cannot just spend it lavishly. Things that need to be spent on need to be very important. We should focus more on structural development, infrastructures and the rest, rather than all these things that we're spending money more on. And also, we need to get very serious in terms of fiscal policy needs to get very serious. They need to invest in what needs to be invested in, right? Shun off and cut off any unnecessary spending. And we need to boost the foreign market productivity. And foreign market's perception of the market, or our market in any ways. And
we're very grateful to you both. Ajibola Tobi-Osho, Emerging Markets Fixed Income Expert, and of course, Muyiwa Oni, Head Equity Research, West Africa, Standard Bank Group Securities. Thank you both for joining us. Appreciate it.